What's happening, guys? This video is going to be about fair value gaps, what a fair value gap is, and also we're going to cover inverse fair value gaps as well. And we're also going to go over which fair value gaps are actually valid for us to take on entries to gain a bias from. We're actually going to cover the basics of what a fair value gap is and how to actually recognise them and spot them in the market. Now, fair value gaps happen on every single time frame, from the daily, the weekly, 4 hour, 1 hour, 15 minute, 5 minute, 1 minute. There'll always be fair value gaps within each time frame as well. So what actually is a fair value gap? So a fair value gap is a 3-candle formation where you have a gap in price between the 3 candles. So here, for example, is a fair value gap. Now you can see that we have 1, 2, 3 candles, and between these 3 candles is a gap in price between the bottom of the first wick and the top of the third wick or body. There's not much of a wick on this candle, but there is one if you zoom in on price. Now this gap is where institutions are actually placing their big orders in the market. And like I said, there are fair value gaps on every single time frame. So here on the 1 hour, we have a fair value gap there. It's a bulk of orders, what is placed by institutions. Now what happens with fair value gaps is price tends to come back into these areas so they can mitigate price and so they can rebalance the market, because this is an inefficiency in the market. We need to actually be able to fill this area so that we can actually get an order within the market. And they're also mandated by governments that these areas need to be refilled by price. And these areas are also where we can look to get entries within. As price tends to respect the order flow of which we are going. So currently we're downtrending and we're putting in bearish fair value gaps. So in order for price to keep moving down, price will come up into this inefficiency and fill it. It doesn't have to be halfway, it doesn't have to be full, it just has to enter this area and mitigate the price there, and then tends to actually move down in respect to the trend. Now what happens when you get an inverse fair value gap? So an inverse fair value gap is when, in this example, a bullish fair value gap gets disrespected by bearish order flow. So bearish order flow is closed through this bullish imbalance and inversed it, whilst also creating a bearish fair value gap. These inverses of fair value gaps tend to signal a shifting order flow in which way we're heading. So you could see that we are actually trending upwards here, putting in higher highs and higher lows, higher high, but then we inverse this, then creating lower highs and lower lows. When we use fair value gaps to determine our bias, because that's how we actually determine a bias using these actual fair value gaps, we cannot look for fair value gaps to assume a bias from that have already been inversed. So this fair value gap has been previously inversed by this candle. So now if we were looking to take a short in this candle, we wouldn't be able to use it. We'd have to wait for a tap back into this 4-hour candle. So how do we actually use these fair value gaps to gain entries? Of course, we can't just use a fair value gap on its own to then go straight into the 1 minute and actually take an entry. We have to use other confluences paired with these fair value gaps to actually take an entry. Also, these fair value gaps signal strong selling pressure in this direction. So in this direction we're bearish, so this is strong selling pressure to go bearish and follow the trend. We can use the same fair value gap multiple times unless we have actually inversed it. So say for example here we actually closed above this and then we came back down like we have here, but then we came back up again here and tapped it, we wouldn't be able to use this fair value gap anymore because it's been inversed. So we would have to look for a higher up fair value gap to be able to get a bias from, which would be this one. And it doesn't matter how small or big the actual fair value gap, it doesn't make it more valid than a bigger one or less valid than a bigger one if you've got a small fair value gap. But since we use fair value gaps to actually gain a bias, then you have to have multiple different fair value gaps on different time frames to actually create a bias from those fair value gaps. So here on the 1 hour you can see that we've actually tapped into this 1 hour fair value gap. On the 4 hour, we've previously tapped into this 4 hour fair value gap, and we have actually started to react from the fair value gap, continuing in its direction to the 15 minute. We've also tapped back into this fair value gap, and then we're intending to actually continue with the trend of where price is most likely to go. So once you've actually tapped into these areas on each time frame, that's when you're looking on the 1 minute for actual confluences that price is going to start delivering lower. So here, for example, we had a market structure shift with a fair value gap. So on the 1 minute again, we've got a fair value gap signalling strong bearish momentum to the downside. So these are the areas what we look to get in, as if we are supposed to respect price, ideally we should be starting to deliver lower, as we have other confluences like market structure shift and mitigation blocks. We should start to deliver lower. So just to recap what a fair value gap is, it's a gap in price between 3 candles. So you have candle 1, candle 2 and candle 3. Candle 1 has a body wick and candle 3 also has a wick. So we mark it from the low of the first candle wick to the high of the third candle wick. This is a bearish fair value gap. This is how you mark a bearish fair value gap. So for a bullish fair value gap, we have candle 1, candle 2, candle 3. Mark it from the first candle's high of the wick to the third candle's low of the wick. And this is a bullish fair value gap. And you can see everywhere in price, it always comes back to test these fair value gaps and to mitigate them in order to continue in the direction of the trend. So we're bullish here, so it's going to start delivering higher from this area. And again, it tapped it here as well, moved up slightly, but then we actually ended up reversing and we actually closed below the fair value gap here. So we've got an inverse fair value gap here. We also have manipulation of fair value gaps. So people who set their stop loss on the outside, on the very outside of the fair value gap, will all be stopped out, because price tends to manipulate these fair value gaps in order to stop out people who are putting their stops at this level, and then continues. And we also can see a big manipulation here, and then it continues the trend bullish from this area. So this is what the actual manipulation looks like on the 1 minute. So on the 1 minute we're actually closing below this 1 hour fair value gap, but then once price comes back into this area, you can see where price has actually reacted from it on the 1 hour, but we haven't closed outside of it on the 1 hour yet. Once we get back up to this area and the hourly closes, then it will show you the actual damage. Hopefully that video made sense for you, and now you understand what a fair value gap is and what an inverse fair value gap is, and which fair value gaps we go off to determine if we will respect it or not, or if it's valid or not, to be able to use to continue in the direction of the market. Thanks for watching. Thanks for watching.